So I've talked for many, many years about the national debt and how that is going to create lots and lots of inflationary pressure in years to come. And of course, how we as income property investors benefit so greatly from inflation, because of course, our assets are indexed to inflation. And that's sort of the amateur view: rents and the asset itself, the property, indexed to inflation very, very nicely. But even better than that is that our debt is debased or reduced by inflation. Of course, my trademark term, inflation induced debt destruction. And that is phenomenal. But just look at how severe this inflationary pressure is getting. I saw this clip in one of my newsletters and just had to share it with you today. And it says the US national debt is settling into a staggering new pattern, increasing by $1 trillion every 100 days. Wow. Wow. That is absolutely staggering. So we stand at about $34 trillion at the time of this recording. And in 100 days, we will see a $1 trillion increase in that national debt. In 200 days, $2 trillion increase, et cetera, et cetera, et cetera. And the only way to really manage this debt properly is to inflate it away. Well, I shouldn't say properly, because that's not the proper way to do it. The old-fashioned proper way to do it is to simply stop spending like a drunken sailor. Hey, I'm going to put on my sailor hat here to commemorate our upcoming cruise. Yes, I hope you're joining us for our Empowered Investor Cruise, where we will talk about this and many, many other issues. But it reminds me of what former presidential candidate Pat Buchanan, he was on the show, maybe you heard that old episode, and he said, your debts will be floated away on a sea of inflation. And with my captain's hat and our cruise coming up, that's sort of a perfect thing to mention. But a $1 trillion increase in the national debt every 100 days, you better get yourself on the right side of that trade by having a lot of assets that are indexed to inflation, and their debt on those assets is debased by that inflation. A really, really phenomenal opportunity. No other asset class has the special unique characteristics of income property. Okay, let's take a look at an income property. So we looked at this Class A property in a Class A market, Sarasota, Florida. And here we look at the property with the lowest down payment and the best leverage with creative financing, because you can take this deal subject to the existing loan, which is only 4.375%. So that's pretty good. But the seller is offering a seller carryback on this property at 10%. So that's a little expensive, but the seller carryback portion of the property value in the stack, in the capital stack, isn't that high. It's a seller carryback loan where you get into this property for only 15% down. You have the best available leverage opportunity. But most people, because they don't know how to really do the math of income property, would not like this deal. This would require a very aware real estate investor to understand the deferred down payment, the creative financing benefits, and most won't like this deal. So we're going to look at the same property three different ways, same property. All right. So the property has a rental income. It's currently rented for $3,200 a month. All right. Now we impute a vacancy rate, even though it's got a 1-year lease on it, of 8%. In other words, it's vacant 1 month per year. With this deal, the property has a cap rate of 4.7%, but a cash on cash return that most people would consider awful at negative 8%, but an overall return on investment of positive 34%. That's because of the incredible benefit of leverage. You have a lot of leverage on this deal. Now, that gives you a deferred down payment because remember, you're only putting 15% down. In a normal scenario, you would put an additional 10% down and you do 25% down on this property. We're going to look at that in just a moment and see how that pro forma looks. Okay, so here you have a deferred down payment or a negative cash flow of $617 per month. Most people would think this deal is not for me. A smart investor would love the leverage offered by this deal. Okay, because you get into this property with only $90,000. Now, remember, if this were on a C-class, lower-end property that wasn't in a prime market like Sarasota, Florida, I mean, Sarasota is definitely a Class A market. In fact, I keep telling my own mother that she should move there because it is such a charming city. It has arts, it has playhouses, it has opera, it has wonderful restaurants. I mean, this is not your typical low-end rental market, okay? This is not Memphis, where you're going to have much better cash flow in a market like Memphis. This is Class A property. This property is only, 3 years old, 2.5 years old, something like that. And it's a Class A market. So the numbers will never be as good in this type of market because we always just project a modest 6% appreciation. But these markets and these types of properties tend to have much better appreciation than that. So, over time, you average it over years. But let's just go with what we're projecting here. Just understand those factors. Okay, let's look at the next example. So this example number 1, is the lowest down payment and the best leverage. What is example number 2? Okay, here is the traditional deal, 25% down. But remember, you still have creative financing here because you have a seller carryback and a subject to deal where you can capture the existing loan at only 4.375%, not the much higher current interest rates. What does this deal look like? All right, here you're putting 25% down, so that's $143,000. And the loan to value ratio on the subject to the first loan that you're taking as is at 4.375%. That's a 63% loan to value. And you're getting a smaller second from the seller at 10%. So that's high, but it's a small amount of the capital stack. It's only $63,000. And here you have basically an overall return on investment projected at 25% annually. But you do have deferred down payment, and that is 1% negative cash on cash return. You're paying $176 per month on this property, but your leverage is better. So you got a 25% overall cash on cash return. Remember, the cap rate or capitalization rate is the same in every example. Why? Because the cap rate does not take into account the financing. And what we're doing here is we're doing the same property financed 3 different ways. Okay, so cap rate 4.7% no matter what. Let's look at the third example. Now, this example is really offering 3 different options. You could either buy outright with cash to existing loan. You still take the first loan, the existing loan subject to, at only 4.375% financing, and you put cash down of $250,000. Or you take the second loan and you project into the future that seller carryback that we had on the first 2 deals, and you pay that off in 2 years. And you assume no appreciation on this property in 2 years. And you do assume a modest increase in rent. The rent over 2 years went from $3,200 to $3,450. Okay, all right. So the rent went up modestly, but the value did not go up. So we're not showing any return on investment on increase in value. Okay, so here, most investors would think this one is the best deal because it has positive cash flow of $749 a month. Positive cash flow, phenomenal positive cash flow of $749 a month, because this existing loan is so cheap. It's only 4.375% interest. Great deal. And your loan to value ratio is only 54%. So you get a lot of equity in this property. Now, your cap rate went up a little bit because your rent went up a little bit over the course of that 2-year period. So here, your cash on cash return is projected at 4%. But your total return on investment went down to 18%, which is still very good. I mean, try getting 18% very reliably and consistently in anything else, right? So most people would consider this the best deal, the best way to buy it. It certainly is what most people would consider the most quote unquote conservative way, but actually it's counterintuitive. This is not the most conservative way. This way is actually more risky, but you'd have to have followed my work for a while to understand, and I don't have time to go into all of those details today. It's counterintuitive. I get it. One of the most important things that you need to do to become a good real estate investor is you need to really learn how to do the math of real estate investing. And this is pretty easy and it's free. Just go and get a free account at propertytracker.com. It's totally free. And what I want you to do is start running these different projections, like I did for you just now, with different assumptions. Assume different rental amounts, assume different amounts of appreciation, assume different financing options, which is what I did here in these 3 examples I just showed you. Okay. And run these projections differently. And after you do this, I've done it, well, not hundreds of times. I've done this thousands of times because I've been using this software for 20 years. It's really the best evaluator software out there. And what you get is you start to really get an intuitive understanding of the math and of these different scenarios. And that's what I want for you. I want you to really, really have like a feel, just an intuitive understanding of the math of income property. And the best way to do that is just go get a free account at propertytracker.com. Go do that now. Propertytracker.com, free account, cost you nothing. Start running your own projections, your own pro formas. You can run it on this property. You can go to jasonhartman.com. You can look at other properties. All of these pro formas are up at jasonhartman.com as static pro formas. But if you want to make them dynamic, where you can change the assumptions, you need that free account at propertytracker.com. So go check that out. All right. Speaking of software and running the math, some of you are asking, should I bring my laptop on the cruise? We've got our upcoming cruise. More details at jasonhartman.com about that. Yes, of course you should bring your laptop. We're going to have such a great opportunity here to sit down at a table at a meal, open up screens, these modern ships, the beautiful new Celebrity Apex. The Wi-Fi is super fast and you're really just totally connected nowadays. It's really great. I mean, I love it. Some people talk about digital detox and unplugging. I like being connected personally because the internet is like a second brain, right? And why would I want to only have my one brain when I can have 2 brains, right? Whenever I want to know something, I can just so easily access it. And remember, at our event, the drink package is included, the Wi-Fi package is included, and the gratuities are included. It's all included on your cruise on the beautiful Celebrity Apex. So I would definitely recommend bringing your laptop because you're going to want to run assumptions and, the investment counselors are going to be there. They can help you run assumptions on your computer and all of this great stuff. So I would recommend bring your laptop. If you don't want to, hey, don't, but you just can't do things as well on a phone or an iPad. I just like having my with me. So I bring it almost everywhere.